So, January 30th, 2026. It was an absolute bloodbath in the financial world. Historians are already calling it Precious Metals Black Friday. And if you were brave enough to look at your portfolio that day, trust me, you were not alone in feeling that shock. So in this explainer, we're going to break it all down. We're going to dissect the anatomy of that crash and really try to separate the signal from all the noise.
I mean, the numbers were just staggering. Silver, the devil's metal, it absolutely lived up to its volatile reputation, plunging 28% in a single day. To put that in perspective, that was the single worst trading day for silver since the Hunt brothers' infamous collapse way back in 1980.
And look, this wasn't just a precious metals story. No way. This thing sent a shockwave ripping across the entire globe. Get this, in just 48 hours, almost $5 trillion simply vanished from the markets. This wasn't just a little dip, you guys. This was a violent structural correction. Something in the very foundation of the market just broke. Which, of course, brings us to the big question on everyone's mind. What on earth just happened, right? How can a market that looked unstoppable just a week ago suddenly fall off a cliff with this much force? Let's dig in.
Okay, so let's start with the wipeout itself. You really can't overstate the scale of this thing. We're talking about a massive liquidation event where, for a period of time, the market just forgot how to find a fair price because the selling pressure was just that intense. When you look at the raw numbers, it's pretty brutal. Silver collapsed from a peak of $121 all the way down to just over $83. And gold? Yeah, it wasn't spared either. It shed over 11%, dropping from its high of $5,600. The volatility was so nuts that exchanges actually had to schedule special sessions just to clear the backlog. Insane.
All right, so the big question, why did this happen? Look, a crash this big is never, ever about just one thing. It's always a perfect storm, right? A bunch of different catalysts all hitting at the exact same time.
And in this case, we're looking at three main drivers. First, we've got something called the Warsh Shock. Then there was a massive leverage squeeze. And finally, a really important one that was happening behind the scenes, a supply lockdown. Let's dig into each of these.
So the first domino to fall was actually political. President Trump's nomination of Kevin Warsh to be the next Fed chair sent a huge tremor through the markets. See, Warsh is known as an inflation hawk, which is basically market speak for someone who likes to raise interest rates. So the second his name was mentioned, the market started pricing in a future with higher rates, instantly. And what happens then? The US dollar and bond yields spike, which is almost always a headwind for assets like gold and silver, because they don't pay any interest, so they suddenly look less attractive. But let's be real. A change in Fed chair expectations doesn't cause a 30% drop overnight. For that kind of chaos, you need one thing: leverage. On the day of the crash, the CME exchange jacked up its margin requirements. This quote from one of the analysts just nails it. Think about that. For thousands of traders using borrowed money to bet on rising prices, this was game over. They were forced to sell, right then, at any price they could get.
And that's what created this liquidation cascade. It's just this incredibly vicious feedback loop. One group gets a margin call and is forced to sell. That selling pushes prices down. That lower price then triggers margin calls for the next group of traders, and they're forced to sell, pushing prices even lower. You see how it works? It just feeds on itself. And the key thing to get here is that this has nothing to do with the actual value of gold or silver. It's all about the brutal mechanics of debt.
Okay, so while all this financial drama was unfolding on screens, something massive was happening in the real world, on the physical side. China started restricting its exports of physical silver. They're basically hoarding their supply to feed their own hungry solar and AI industries. This created a huge disconnect between that crashing paper price and what was really happening with the physical metal.
And that brings us right to the core conflict in this whole market. It's really a war between two different worlds: the paper market, which is like a giant casino, and the physical market, the vault.
This one number pretty much says it all. At the peak of this, there were paper contracts out there for 528 million ounces of silver. But guess how much actual physical silver was registered and available for delivery? Only 113 million ounces. That is just a mind-blowing amount of leverage built up in the system.
So you really do have these two completely separate worlds. On one hand, you've got the paper market. We're calling it the casino. It's totally dominated by speculators and leverage, and it's super vulnerable to these margin calls and shifts in sentiment. And then you have the physical market, the vault.
This is driven by real industrial users, by sovereign buyers like central banks. The price here is set by actual supply and demand. And right now, that physical inventory is tighter than it's ever been.
And that leads us to this quote, which just perfectly sums up the situation. All the panic, all the forced selling, that was a fire in the casino. Meanwhile, the vault, where the real stuff is still basically empty, and everyone still wants what's in it. Okay, so after all that chaos, you'd think the big institutional players, the big banks, would be running for the hills, right? Well, that's not what's happening at all. In fact, the analysis coming out of these institutions is surprisingly calm. They're basically saying the long-term trend is far from over.
I mean, JP Morgan is out there calling this a buying opportunity. You've got Goldman Sachs saying the structural bull market remains intact. Saxo Bank is calling it a volatility trap that was actually necessary to clear out all the excess leverage. And here's the bottom line. The fundamental reasons that people, especially central banks, were buying gold in the first place, those haven't changed one bit.
And then there's the other part of the story, this relentless, unyielding industrial demand, especially for silver. Think about this. A new AI data center needs 2.5 times more silver than a traditional one. A next-gen solar panel needs 1.5 times. And here's the kicker. These buyers are basically price insensitive. A solar panel company can't just decide to use copper instead. They need silver. They have to buy it, no matter the price. And that creates a really solid floor under the market.
All right, so after a historic shock and what some are calling a necessary reset, what happens now? What are the experts looking at for the rest of 2026?
Well, the first thing everyone's watching for is stabilization. Analysts are looking at these levels as the absolute line in the sand. We're talking $75 for silver and $4,500 for gold. If the prices can hold above those floors for the next few weeks, that's a huge signal that the worst of the selling is probably behind us.
And if you look further out, the recovery targets from these same banks are, well, they're incredibly ambitious. Even after this massive crash, Saxo Bank is still calling for $6,000 gold by the end of the year. JP Morgan is looking for a recovery back to the $5,000 to $5,100 range. And for silver, Citigroup is projecting a stunning rebound to between $130 and $150 an ounce.
So, at the end of the day, this precious metals Black Friday was just a really painful reminder of that old market saying, the elevator down is always way faster than the stairs up. The speculators, the folks who are over-leveraged, they've been completely purged from the market. And what's left behind are the fundamentals. Which really leaves us with this final thought, a classic for a reason. In markets like this, wealth isn't destroyed, it's just transferred, from the impatient to the patient.